In the year 2008, a crisis in the automobile industry cost billions of dollars in a span of months. Every company struggled during that time because of a massive decline in sales. Toyota experienced their first loss in 20 years, Honda car sales dropped 31.6%, Ford had to secure a line of credit from the government, and the US government bailed out GM and Chrysler. All dealerships were at their lowest point in years, which forced them to make permanent changes. Overnight, the $2.8 trillion industry fell apart just like that. However, we might see the same thing, or maybe even worse, happening right now based on indicators that Cathie Wood has spotted. This means serious trouble and the world might be facing a complete disaster. Welcome to Empire Investing, where you'll be sharing the latest in stock market news, technology, and innovative investment strategies for aspiring millionaires and billionaires. If this is your first time watching our channel, welcome, and please do consider subscribing to see more videos just like this. And with that, let's go ahead and get started. When it comes to the financial industry, surveys are extremely important. This is where the University of Michigan Consumer Sentiment Survey comes in. They're known to be one of the best and most dependable surveys, and one of the vital components of their survey includes this question that has been asked since 1961. Speaking of the automobile market, do you think the next 12 months or so will be a good time or a bad time to buy a new vehicle, such as a car, pickup, van, or sport utility vehicle? Based on this graph, you can see that indicators are showing that it's a bad time to purchase a vehicle in our current situation. This is the highest number of negative consumer sentiment in the history of the survey. Despite what the graph is showing, car companies are still claiming that there's still a huge demand for vehicles. However, that's not the case at all. The automobile prices are rising, not because of a lack of demand, but because of a lack of supply. The major cause for prices to rise is because dealer inventories are dropping at record lows. Same goes for the consumer demand for vehicles. Almost, if not all, automakers are rushing to get new semiconductors for their vehicles, but the demand for it might not be there anymore by the time the chips arrive. The automobile industry is going through an undeniable shift towards EVs, which brings the consumers to wait for new developments. Not only that, with car prices increasing left and right, the industry is now in serious trouble. Over the past 3 years, the average price for a new car increased by $11,000. As cited by the University of Michigan, this increase in prices causes consumer sentiments to become even lower. This means that the current car prices are not sustainable at all. The decelerating growth of car prices are perfectly demonstrated by the Manheim Used Vehicle Value Index. There's a huge price bubble and the supply is not hesitating to catch up. As supply increases while the demand is low, the automaker industry might be in a glut or the oversupply of goods, which leads to a huge crash in prices. Many, including Elon Musk, GM, and Lisa Su, are saying that the chip supply constraints are dissipating. What I've discussed so far is what Sam Corris, an analyst from Ark Invest, has been focusing on. The industry sales are showing signs of a rebound from the chip shortage. The total number of vehicle sales in January of this year came in at 15.5 million vehicles, which was 20% more from the previous month, which is a fair enough increase and still fulfills the remaining consumer demand from the supply shortage. However, once the demand for higher-priced vehicles is met, more urgent demands will most likely appear, which is what Cathie believes to be a quote-unquote build-up, which might start the biggest price crash in the history of the auto industry. And what we believe has happened there is the various automakers had been building up inventories at the factories or near the factories, just waiting to put in chips, as we heard all about the chip shortage during the last year. And so they're now saying that chip shortage is alleviating. So there have been people waiting for their orders to be delivered, but if this survey is right, there's not going to be much follow-through. Cathie Wood. The crash which Cathie is indicating isn't just for automobiles specifically, but general goods as well. The inventory to sales ratio closed at 1.29 in December of 2021, which was 3.2% more from the previous month. It may not seem like a huge increase, but if we look at it annually, that's a 38% increase in 2021. This increase caused more supply plants to ramp up their production. As the CEO of AMD, Lisa Su, stated in a conference, many businesses have invested in new supply plants because of the shortages in supply. However, the supply plants don't go into production right away. On average, it takes about 18 to 24 months for a supply plant to go into production. If a business invests in the supply plant in the late 2020s, a supply rebound might happen as early as 2022. We've all been hearing about Cathie's prediction about the crash in goods prices, and since it's not playing out yet, Ark Invest's ETFs are declining. However, if her predictions are true, then the world will be in a complete shock. There are two trends that come to play for inflation. The first trend is disruptive innovation competing with traditional companies. Because of higher competition, prices are forced to be lowered. That's why gas-powered vehicles are now lowering their prices to compete with EVs or hybrid vehicles. The second trend is production efficiency. Due to the fact that the current technology being produced has improved, prices have been lowered. EVs are the perfect example of striving to achieve lower prices. As the prices of batteries go down every year, the accessibility of EVs to the public increases. This innovation is inherently deflationary because consumers are now having the opportunity to acquire goods at lower prices. On the other hand, the inflationary trend is cyclical, as we've talked about earlier. Cathie believes that inflation is centered around supply rather than demand. Listen to Cathie's explanation on CNBC. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go to 50 basis points in March, which they might, I think that it would be one and done then. We'll end up with an inverted yield curve, and then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out, something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both are right, and so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense while inventory sales ratios might be low as the consumer switches off here, and if you look at the last 3 months of either retail sales or consumption, the consumers have gone pretty flat. Meanwhile, you've got the double ordering, the triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here. It's going to hit within the next 6 months in terms of that recognition. Cathie Wood. The automobile sector exemplifies the economy as a whole. The prices have increased at an exponential rate because of inventories being low for the past year. The increase of 12% in new vehicle prices over the past 12 months isn't sustainable, and this is similar to the prices of the overall economy. Similar to the chip shortage in the auto industry, inventories overall in the global economy are now rebounding. As soon as the new supply plants enter, there will be an economic slowdown. The prices of used cars fell to about 20% in 2008, which was already a huge decrease at the time. However, given our current economic situation, we might be seeing a 60 to 70% crash coming soon. What do you guys think will happen to car prices over the coming year, this 2022? Do you believe the automotive industry bubble will burst? That's all for today. Join the discussion in the comments below, and if you like the video, please click the like and subscribe buttons. See you guys in the next video.